Hi, Matt Davis here with GDI Insurance. Wanted to go over a quick update of the marketplace in preparation so you as a consumer don't become a victim of either non-renewal or cancellation of your insurance policies. Right now, insurance companies, like any other business, are in business to make a profit. Knowing that the profit motive is there, there are actions and steps you can take to protect yourself and protect your cost structure so you don't overpay. First thing we need to do, though, is understand really what's happening in the marketplace and what's causing insurance companies to take these drastic steps that you're hearing about, whether they're leaving the marketplace, they're limiting production, whatever it is. So first off, insurance companies are hemorrhaging financially. Pretty much since the most recent wildfires out here in California over the last 5 or 6 years, all profits from the preceding 30 years before that have been pretty much completely wiped off the table. So if you think about the legacy carriers like State Farm and Farmers, they've made little to no profit over the course of many, many people's lifetimes now that are actually in the adult world. If you think about almost 40 years, claims costs are inflating. At the same time, the insurance companies are stopped from raising any rate or cost and passing that along to the consumer, meaning that they're hemorrhaging even further. And then to add on to that, there's what's called adverse selection, and they're forced into that by certain state departments of insurance that then put moratoriums on the ability of an insurance company to non-renew certain geographic territories in order to stay solvent. So you have these problems that are happening, and each one of them compounds on another. There's not one solution that can be found to fix the problem as if we were in a vacuum and just have one quick light switch flip. California is a good example during the COVID-19 period, which we're now out of, thankfully. There were over 20 straight months, consecutive months, where the Department of Insurance in California refused to consider or authorize rate changes up or down for home and auto insurance in the state. On top of that, or I should say with that, remember, costs were increasing and they're still continuing to increase now in 2023. Insurance companies are just now starting to get some little bits of rate relief there. But at the same time that was happening, the insurance companies were also mandating that insurance companies pay refunds or returns on premium back retroactively, and in the case of wildfire scenarios, pay 50 or 75% of maximum limits, even when those limits weren't justifiably exposed to being paid. So if we think about it, and let's say we're a contractor, we think that we're going to need, 80 bags of concrete to do a patio, or up to 80 bags. And we're about halfway through and we're like, oh man, we're only going to need 60 bags. So we could think of returning to Home Depot or Ace those 20 extra bags, and then your city or county coming in and say, no, you're going to have to use all 80 bags no matter what. Or in some scenarios, you're going to have to use 100 bags. And what happens? You just leave them there with the homeowner who you're doing the work for, and they get the benefit of it. That's essentially what happened during the Paradise Fire and other fires, where we all heard the stories of people whose homes burned and they were using insurance money to fly across the country and buy secondary homes. It's unfortunate, and now we're all paying for it. On top of that, because rates have not gone up, reinsurance costs have gone up with the inflation of the claim costs. So reinsurance is the insurance on the insurance that you have. Well, that's gone up 20% or more over the last year or two. And so now that's being reflected in carrier profitability. That's why you see companies like Nationwide across the country not issuing certain types of policies, and in California and about half the other states not doing any home or auto going forward. Another thing the insurance companies are having the issue is they can't separate themselves from higher risk clients. California is an example. If a wildfire disaster is announced today, it's not a year from today before an insurance company who does business in those zip codes that are the disaster can get away from customers. It's a year after that emergency order is lifted. So if that emergency order is in place for 18 months, it's 12 months after that. So we're talking 30 months from the date of the fire before an insurance company can non-renew business that they're losing money on in those zip codes or any zip codes that neighbor it in the state of California. So we see that there's a lot of restrictions on how they can operate. Next, you have to look at insurance companies are trying now to exit underperforming areas. That's why you're hearing the doom and gloom about home and auto insurance is so hard to get right now. Commercial auto insurance has been getting harder and harder to find cost effective for the past 3 to 4 years, if not longer. It's probably been 7 or 8 that's been hardening there. Commercial properties fall in the same way as homeowners insurance. So is earthquake across both commercial and residential type properties. Umbrella and excess liability has gone up considerably. We have clients that have grown 20% over the last 5 years in gross revenue, but their umbrella premium has quadrupled in the same time period. So the basis or the exposure for the insurance company in theory has gone up 20%, but they're collecting 400% the premium dollars now. And then farm and ag, there's certain industries that are getting hit. Dairy in California is very hard to cover right now. Few carriers are interested in really being cost competitive, and there is not an effective E&S or excess and surplus lines backup market for it. The FAIR plan will be cited as an option. However, you cannot cover many of the necessities that would be on a companion difference in conditions, or what's known as a wrap policy around the FAIR plan. They're not available in the state of California. Then on top of that, insurance companies are now instituting 2 to 4 week or more underwriting holds if they are covering certain types of business. What that's doing is that's getting rid of those last minute customers who need a quote today or tomorrow, because unfortunately the statistics prove those customers are far less profitable. They're actually far more unprofitable than any others. And right now, the one good thing is workers' comp doesn't seem to have been impacted just yet, but there is some writing on the wall with 3 straight years of compounded medical claim cost increases that the Department of Insurance has not authorized the rates to be raised on. So that's the state of the market. It's a lot of doom and gloom, but if you find a good independent agent or broker out there that's in a good territory and has been historically issuing and servicing good business from an insurance company standpoint, we are still able to write coverage in pretty much every territory of the state of California and most jurisdictions nationwide. Best of luck to everybody, and hopefully this isn't the worst thing in the world. Stay tuned for the next video, though, and we'll go over how you can protect yourself and take small steps. They're pretty easy to make sure you don't become a victim of these non-renewals and drastic rate increases. All right, guys. Bye.